Well, I want to thank you for having me here today on this beautiful sunny day out there. It's finally have a spring day here at Brookhaven. And we're going to be talking about real estate today and the mortgage process. My name is Joe Jannace. I've been a real estate broker for this my 40th year in the business. And I've been with the Foundation for Personal Financial Education for, I guess it's about 3.5 years now. And our goal is to give information free of charge and share our knowledge with different people in different work atmospheres. There you go. The topics that we're going to cover today are where are we today in the real estate market, reasons to own a home, understanding the mortgage process. I'm going to try to take you step by step through how the banks look at things, and the home buying process. And then I'll try to answer any questions that you have also that's not covered. The industry's had a lot of changes over the last several years, and as of January of 2010, federal licensing of all mortgage loan originators became required. They also had testing requirements and education requirements, which is odd when you think about it. For years. They never had that in order for banks to give out loans. They also have new good faith estimates. I'm going to talk about that in detail for a few moments. New truth in lending process, and new appraisal ordering processes. At one time, a lot of the banks or mortgage brokers had their favorite appraiser that got all their business. And a lot of the reasons why we had the problems that we have today is those appraisers did favors and had homes getting mortgages for a lot more than what they were worth. Today, the banks require that they use what's called a mortgage appraisal company or management firm that they then hire all the appraisers through, and they have a rotating basis. So there's no set person that gets all the business from one lender. How much can we afford? Today, lenders typically use two ratios to figure out how much you could qualify. The first one is 28 to 36% of your gross monthly income, and that's your housing expense. What I talk about by housing expense, that's the mortgage, principal, interest, taxes, and insurance. The debt ratio income is between 38 and 45%. What that takes in is all the mortgage expenses plus any other loans you have, credit cards, student loans, auto loans, alimony. Income, by the way, takes in child support also. So that's the ratios that the banks work on. Some lenders will give you as high as 45% of on the first ratio, also the housing ratio, depending on your credit score, depending on your down payment, and there is some flexibility. If you utilize the FHA, they're a lot more flexible than the conventional banks and conventional lenders today. The good faith prior to 2010 was a one-page form with an estimate of what the closing costs would be. There's no recourse against the lender or the mortgage broker if they lowballed, and more often than not, the numbers that they gave are a lot lower than what they should be. And not a valid gauge of the actual cost of getting a mortgage. Since then, it's now a 3-page form with the worst case scenario for the fees. Full recourse for the lender and or broker if they lowball. And it's a true valid gauge of what your closing costs are going to be. What was happening is buyers were getting there and they were finding out a lender could, just give you an example, on prepaid interest, it could be anything from $25 to $2,000, and the lenders would quote the $25 part, not the $2,000. And depending on what day you close of the month, you could have a big difference on that. Those of you who just walked in, there's packages in the front with notes if you want to grab any on it. So, PMI is private mortgage insurance. If you put down less than 20% down payment on a conventional mortgage today, the banks require you to have PMI. If you go for an FHA loan, they have mortgage insurance premium. Up until April 1st, that premium was there for about a 7-year time period. Now it's for the life of the mortgage. It's roughly about 1.25% of the mortgage. So if you're going for a $300,000 mortgage, it would be roughly about $4,500 that they would add to the mortgage that you would owe, and you'd be making a monthly payment on towards that PMI. A big reason why a lot of the banks got into trouble was throughout the late 90s and early 2000s, they came up with a new type of loan where it was a two-step, and what they did was they lent you 80% from one bank, and then another bank lent you the other 10, 15, or even in some cases 20%. So the bank, you really had no equity involved in the house at all. And you also had no PMI insurance because the second mortgage lender was lending that money. And that's really a big reason why we have a lot of the short sales and foreclosures today, because they try to get around the PMI insurance. You're going to see it's going to be around for a long time now, and there's less mortgage insurers out there because a lot of them got hit hard with the foreclosures. Because of that, the mortgage insurance companies are more stricter today than the lenders. You can go to the bank where the bank will approve your loan, and then when they send it out to PMI, PMI may reject it or require additional information or documentation. So today, the PMI lenders are having a lot more weight than the actual banks on the mortgage approvals. The difference between conventional and FHA, you have limited ratios on the FHA where they won't go above the 36 in some cases. Limited credit scores, they won't go below a certain credit score for different programs that the banks have. Limited down payments, they want at least 10, 15, 20% down. Most of them won't allow a cosigner. And if you have less than 80%, they want the mortgage premium insurance. On the FHA, on the other hand, extended ratios. I've seen an FHA give a buyer a mortgage approval where their debt ratio is 48%, and the loan-to-value ratio is 45%. They just felt that the person had such good credit and everything else was so solid that they were willing to give a little bit extra flexibility there. They'll give a lower credit score. You have in the low 600s, and the FHA will still give you a mortgage, where in the conventionals, they want a 720, 730, 740, or above. If you think about investment real estate, most of the time you have to go for an investor's loan, and they don't want to see a credit score in the 700s or more. They're also going to require today that you at least have one previous house that you've owned as an investment property. The reason for that is that if you don't have one previous home, they won't count the full income on the rental. They'll take a lower amount, and it'll actually make it more difficult for you to qualify for a loan on it. They do allow low down payments with the FHA. You can put as low as 3.5% down. We could also raise the price by 6% to include your closing costs. So they'll allow you to finance your closing costs in the FHA. They do allow co-signers, so mom and dad could help you out. And the MIP is now on every loan. Depending on your credit score, this is just a quick example. If you have a 740 or greater, they're probably not going to charge you any additions for that loan. But depending on your score, if you have someplace on a conventional loan in the 650s, 640 range, they may charge as much as 3 points to give you a loan, which is $9,000. Each point on a $300,000 loan is 1%. So they could charge you up to $8,000, $9,000. On 80% financing, they actually have a little bit higher charge. So the better credit you have, the less you're going to pay for the money that you're going to borrow. Today, we have the formula what we call RICE. This is what the banks look at when deciding if they're going to give someone a loan or not. They look at their reserves, their income, credit, and the amount of equity. Especially today, you need all the right ingredients. I strongly recommend, if you're looking for financing, not to go to any of these online websites. Most of them do not have accurate information on the closing costs for New York State because they do it nationwide, and they don't quote all the closing cost expenses that you have. Some of the expenses, I'll give you an example, 6 months taxes they hold in escrow. Well, here in New York, when the average taxes is $10,000, that's $5,000. You need to know that. And if you go to some of these online websites, they don't quote that because that's technically not a closing cost. In addition to that, some of these websites will offer, they'll send it out to 3 or 4 different lenders, and each one will run a credit report for you. The more times your credit is ran, the lower your FICO scores are. So just something else to keep in mind. If you want, there's some names of different places to find out what your FICO scores are and to get a free credit report right there. They're also in the packages I handed out. When determining your credit score, the question everyone always asks, well, how do they get a FICO score? And there's really 35% comes from payment history, showing you make your payments on time. 30% from the amounts that you owe. 15% from the length of your credit history. The longer that you've had credit, the better off you are. 10% for new credit. And the types of credit. They want to see what type of credit. If you're borrowing for a car, well, that's one thing, and they'll look more positive than that. If you have tons of credit card debt, they're going to frown more on that, so they'll give you a little bit lower score. So depending on the type of debt will also affect your credit scores. They take all this into consideration, and a computer meshes it all together and says, here's what your score is. If your score is not that great, there's companies out there that you could work with, and they'll help you increase your credit score substantially. They could, and you could do it independently on your own also, but sometimes they pay a few $100s to have a company do it is well worth it. And I've seen them raise a customer's of mine's credit score by 30, 40, 50 points over a 3-4 month period. And that meant the difference between 1 point extra on the loan and 0 points on the loan. So it could save you quite a bit of money. So if you have any credit questions, check into it. You should get your free credit report once a year anyway, and make sure nothing's taking place that doesn't belong to you on it. Just to give you an idea of where we are in the marketplace, comparing 2011 to 2012, and I apologize, when I closed it, it shifted over. Prices are up by $2,000, less than 1%. In Nassau County, the average price was down $1,000. In Suffolk, it was actually up $1,000. In Queens, it was up $15,000 for 4.3%. The pending sales price, the median price is $350 in Nassau, up from on the island, up from $347 a year ago. That's a 0.9% increase. Closed sales, we had just under 27,000 last year. We had just under 26,000 the year before, so that was up 4.2%. What's really interesting is the sales activity, what went to contract, 29,875 versus 26,918. That's an 11% increase. I wasn't able to put the first quarter numbers together, unfortunately, but the first quarter of this year is showing between 3 and 4% increase on the prices, and the sales across the board are up between 8 and 10% in most communities. At the same time, if you're thinking of selling a home, I strongly recommend having an agent come in and look at the statistics for each community in itself. I have some towns next to each other where one town, the prices have been leveled and even going up about a point a month over the previous year. And the next town right over, the prices are still going down about a point a month from the previous years. So it could have different effects in different marketplaces. Types of mortgages are out there right now. The conventional loans, they'll give you up to $729. Anything over that, it becomes what's called a jumbo loan. FHA, HUD, or VA loans are up to $729 also. And you have a reverse mortgage if you're 62 years old or older on it. Down payments. The down payment for homes is usually between 3.5% and 20% of the purchase price. The amount required down payment depends on your credit history, your income, the cost of the home, and the type of mortgage you're going for. Today, most of our buyers are going for FHA mortgages. Many first-time buyers put down between 3.5% and 5% of the total purchase price. And once again, that's the FHA program. Your closing costs are the fees that you pay when you actually get your loan. I'm going to give you not only closing costs, but all your closing expenses. Because my feeling is, just because something is not technically a cost, doesn't mean you don't have to pay it. And if you have to lay out all that money, you need to know where it's going to. These costs will include your points, taxes, title insurance, financing costs, items that must be prepaid or escrowed, and other settlements. Closing costs could run between 4 and 7% of the purchase price. A lot of it depends on what the property taxes are. Most banks would take between 6 and 8 months' taxes at the time of closing. Here on the island, where the average taxes are $10,000 or more, that's $5,000 or $6,000 right there alone that they're escrowing for you. The typical appraisal is $300. If you need a survey, they run between $350 and $475. The bank's attorney, yes, you pay for the attorney who does all the paperwork for the bank, besides them charge you interest, is $650. Credit reports is $75. New York State mortgage tax, this is, by the way, based on a $300,000 mortgage. New York State mortgage tax is 0.75% less $25. So that comes out to be $2,000. Termite inspections run anything from $75 to $125. Loan origination fee. Now, a lot of the banks don't offer loan origination fees, so that's $3,000 you'll save. But depending on your credit, depending on the amount down payment, it might be required. So that's another $3,000. 6 to 8 months tax escrow is $6,500. Sure. No. When you sell the house, they give it back to you. What they do is this. They, let's say you bought a home today. Your first mortgage payment's June 1st. The bank on June 1st has to also pay the school taxes for half a year. So when you make that first mortgage payment, actually it's not even June 1st, it's July 1st if you close today. Your first mortgage payment is July 1st. So they have no money that they've gotten from you in mortgage payments yet. So from the escrow, they'll take the money to pay your school tax. And then when the general tax comes in a couple months later, they'll take the money to pay that. So they always have between 2 and 6 months taxes that they're holding for you. And then when you make the mortgage payment each month, you're replenishing that escrow account. It's a good question because a lot of people don't realize that you still have to pay it. Same thing with your homeowner's policy. You have to pay for 1 year policy in advance. Homeowners are approximately $1,300. Some banks take out 1/12 of your homeowners each month, and they'll pay it for you after that. Others will just require you to pay it and send them a paid copy at the end of each year. Flood certs, $25. Recording fees run up to about $150. Record the deed, the title, your mortgage papers. Most of those numbers are pretty accurate. This one over here is an approximate because there's 3 different formulas that you have to look up and combine. But it's approximately $2,200 for title insurance. That comes out to $16,800. You can pay for your attorney. Most attorneys charge $12.50. Now here's something. If you're thinking of buying real estate and the attorney tells you they charge by the hour, run as fast as you could from them. No real estate attorney should be charging by the hour. They should be charging a flat fee, anything from $1,000 to $2,000. Most of them in the $1,250 range, $1,250 to $1,500. Adjustments. At one time, this is like a $300 item. But the adjustments are for any taxes that the owner paid in advance. I had a closing on Friday, and the bank paid the taxes that were due June 1st already. So at the closing, the buyer had to reimburse my seller for 2 months' taxes that were prepaid for them. That's an adjustment. There's also oil in the tank. And the price of oil wasn't expensive, that's one thing, but if you have 200 gallons of oil in the tank and it's $3.75, guess what? That's $750 that you have to pay the seller at the closing for the oil in the tank. So these adjustments are what's going to cost you to get into the house. And that's roughly $1,000. That could be a little bit higher or a few dollars lower, but depending on how much oil's in the tank. And last but not least is prepaid interest. Remember I said your first mortgage payment's not until July 1st? Well, the bank doesn't say, and when you pay July 1st, you pay an interest for June. The bank doesn't say, well, you're a nice person, we're not charging you for the May interest. What they do is they take the number of days left in the month, and they figure out the daily interest charge. They times that by the number of remaining days, and that's your prepaid interest. On a $300,000 loan, it's between $25 and $1,500. I went with the middle of the month, $750. That's another $3,000. That's $19,800 is what your closing costs are. Once again, you are allowed with the FHA to increase the price by up to 6% to cover the closing costs. Any questions on the closing costs so far? I'm sorry. Okay. The question was, is there a surcharge that Suffolk County has for land preservations? If I remember correctly, I believe that's for homes that are over $1 million. I don't believe that's for under $1 million. I'm not 100% sure. I'd have to find out for you. Yes. I'm not sure about out east. I can try to find out for you. Yeah. It is? Okay. Mortgage lending today, it's all about the risk. The less risk, the better the deal. The more income you have, the better credit you have, the more equity you put into the house, the more reserves you have in the bank afterwards. You're not using every penny. The more likely they'll give you a loan, and they'll give you lower interest rates on it. Some of the myths about home ownership. It's a bad time to buy a house. Actually, right now is one of the best times to buy a house. Prices are just starting to go back up. So you're getting them before they start to take off again. They're between 30 and 40% below what they were 7, 8 years ago. So, and interest rates today at 3.5%, 4% are at all-time lows. It's more affordable for the first time to own a house on Long Island than it is to rent since the late 70s. So the opportunities there to buy and buy now are very good. Buying a house is just too risky. I'll end up in foreclosure. If you buy within your means, it's not risky. If you buy within your budget and you don't buy with the theory that, well, I'm going to get a raise next year and I'm going to be getting this next year and doing this, and buy with what you can afford today, it's not risky at all. In fact, if you fell behind on your rent after the second month, your landlord will start eviction proceedings and have you thrown out. Unfortunately, the banks, unfortunately in the sense that it hurts the economy, but fortunately for you, if you're the homeowner, they'll give you 2-3 years before they foreclose on you. I have people that have been in the house not paying mortgage payments for 2.5 years, and they haven't even been served papers yet. So if the worst happened and you couldn't make your payments, you're much better off being in the house where they have to foreclose on you than a landlord-tenant court where the judge will throw you out a lot quicker. You cannot buy a home in the U.S. if you're not a citizen. That's not true. If you do not have a bank account or credit cards, you do not qualify for a loan. That's also not true. They will look at other alternative forms of credit. They'll look at your phone bill. If you show them canceled checks for your phone bill. They'll look at rent receipts. They'll look at credit card statements. So the banks are flexible, and they'll look at other things to make you qualify for the mortgage. Lenders will share my personal information with other people. That's also false. Whatever information you give to the bank by privacy laws, they cannot share that with anyone else. In fact, we recommend mortgage companies all the time we do business with, and they'll tell us, Joe, the loan's going smoothly and stuff, but they can't tell us what's going on with the loan because it's against the law. If you're late on your mortgage payments, you'll lose your house. I just explained it. In some cases, they'll let you go 2 and even 3 years. And you cannot get a mortgage if you've changed your job several times in the last few years. That's also not true. Now, if you've switched jobs to improve yourself, or the same type of work, and it's not a problem. If they see that you're switching jobs every 3 months, and then that's more of a problem. So if you've left one job to go to another company and you've gotten a raise or better opportunities there, the banks have no problem with that at all. They do want to see at least 2 or 3 paychecks from the second employer before they'll give a final approval on it. Rates hit another record low last week. Freddie Mac announced the rates were down to 3.675 from 4 1/8 the week before. The 30-year rate, fixed rates a year ago, were at 3.98. Now, here's why now's the best time to buy a house. This number over here, you can figure out, by the way, with this information, you can figure out the mortgage payment on any price, on any home you want to look at. At 3.5%, for every $1,000 that you borrow is $4.49. The chart's right in, that I gave you in the handout. For a $300,000 mortgage, so you times 300 times that number, is $13.47. 5 years ago, when interest rates were 8%, that same house would have been $2,200. That's over an $800 difference. I mean, that makes homes a lot more affordable. At 4.5%, it's $5.07 per thousand, or $15.20. At 5%, it's $5.37. That brings it to $16.10. At $6, it's $6. At 6%, I mean, and that's $1,800. So I mean, you could see the difference. If rates go up to 5%, it's going to be costing almost $300 more for the exact same home. So right now is a really good time to buy. A year from now, we don't know where the interest rates are going to be. The question was, yes, this is without property taxes and these amounts. And then you add 1/12 of the property taxes. Now, why own instead of renting? You have a place that's your own. And I'll tell you, I remember when I bought my first home, I had a really miserable day at work. And I was a young guy, I was 21, I was single. And I came home, and I lit the fireplace, I sat down, and I said, you know what? But this is mine. No matter what they do to me at work is okay. If I'm coming home, this is mine. And just knowing that you have your own place is a good feeling. There's a lot of tax benefits to home ownership, both as an owner-occupant and also as an investor. Your monthly payments will remain stable for the most part, except for the tax increase each year over the life of the mortgage. And you also, by building up equity, you're contributing to your nest egg. The average rent in Nassau and Suffolk counties in 2011 was $1,265 to $2,200 per year, depending on what you rented. Over 10 years, if we went with the $1,265 number, that's $151,000 that you threw out the window. At the $2,200 number, that's $264,000 that you wasted. Over 30 years, $455,000 went out the door on a low number, or almost $800,000 at the $2,200 number. I'm using, the question is, what's the average property tax? I'm using $10,000 for our example today. Well, let's look at that also, because there's tax benefits that will make that change for you. The buying steps, First and foremost, sit down with all of you that are involved, your spouse, your significant other, and talk about what you want, what you could really afford in the budget, what you must have, and what you'd like to have but you can live without. What are the deal breakers? What market contingencies? What time frame? If you don't find a home in a certain time frame, what's your game plan? What towns? Try to have an idea. Next, speak to a loan officer. Get qualified for a mortgage. You need to know what type of finance is available for you. You need to, before you can even make an offer on a property, the first thing every real estate agent is going to ask you is, do you have a pre-approval letter? And they're going to want to see a pre-approval letter that they can share with the homeowner to show that you're a qualified buyer. Most agents will not accept an offer unless they have a pre-approval letter that's submitted with it. So you need to get that done before you even start looking at homes. Search for properties, view the properties, make an offer and negotiate. And here's a big thing with making the offer to negotiate. If it gets rejected, don't take it personally. If you're a homeowner and they lowball you, don't take that personally either. I've seen people lowball and then pay over asking price for the same home. So it's negotiations. At the same time, in today's market, our lower price homes are getting multiple offers on them. Recently, I was putting together what's called a comparative market analysis. That's where we show the homeowners what other properties in the neighborhood sold for. And 3 of the 4 properties I utilized sold for over asking price. So with that in mind, you don't want to make a ridiculous offer. And if you're out there looking at a number of homes, you know what the homes are worth yourself as a buyer. Make a realistic, make a fair offer, and you'll probably do a lot better off. Contract is normally 60 to 90 days. They give you about 45 to get the mortgage, and then depending on everyone's time frames, a little bit of time after that. Contingencies. Well, contingencies could be anything from, the first one and most important is to be subject to getting your mortgage approval, subject to the bank appraisal. But I've had situations where we had to get a contingency subject to a variance, subject to a CO. So there could be a number of different contingencies that may come in, subject to getting a tenant out of a property. And then you have the closing. And there's a buyer, you write a lot of checks, and at the end of it, you get the keys. So it could take anything from 45 to 100 days from start to finish. At the same time, I've seen some people take 6 months or longer. There's no set rule that says the first home can't be the right home, or that you have to look at 70 or 80 homes before you find the right home. It's really, and by the way, bells don't go off when you walk into the right home. I've never seen that happen yet. So, where and how to start? The internet is really where most people start. Public open houses that real estate brokers offer. And then speaking to real estate brokers. By the way, one of the things I find is really, I do training for new agents. And one of the things that we find, very few agents call back to customers who went to open houses. And yet I have so many customers tell me that, well, I don't want to give you my phone number because I don't want to get bothered with a lot of phone calls. If you're serious about buying, leave your phone number with them. And here's a good rule of thumb. The agent who calls you back once or twice, that's the agent you want to work with. The others that don't bother you, they're not going to be bothering and looking for a good deal for you also. The one that's calling you back, they're doing their job, they're following up, and they're more likely to work harder to find your home than the others who just ignored you when you went through on it. In reference to real estate brokers, you have either a broker's agent or a buyer's agent are the 2 different ways that you can go about. A broker's agent represents the seller's best interest. 90% of the salespeople you talk to, and everyone at an open house, represents the seller on a real estate transaction. They're going to be honest and truthful with you. Any questions that you ask us, we have to answer honestly. But we're not able to make suggestions. I can't turn around and say, there's a water stain there, you should have that checked into. Because my responsibility is to the seller. I negotiate for the seller's best interest to get the seller the best terms and price that they want. That's what's a broker's agent. As a consumer, you have the right to hire an agent to represent you as what we call a buyer broker or a buyer's agent. This agent represents your best interest in the transaction. They could make suggestions. They could point out things to you. They're going to advise you on the negotiations. If I represent the seller, my advice is to pay the highest price possible. If I'm representing you, let's put a strategy together to get you the best terms. It's one-stop shopping. You don't have to run around with a dozen different real estate brokers. When you go to open houses, you tell them I'm working with sales person XYZ, and they won't bother you. And also, the exclusive agent is able to show you a lot more listings because they can show you other brokers' exclusives and so forth. You had a question? The question is, where do you find a buyer's agent? A lot of real estate agents will represent you as a buyer's broker. Just ask them. But also ask them if they've done it before and what their experience is. You want to make sure that you have the right person. But there are actually some real estate companies that just represent buyers also. There's one in Nassau that's called Buyer Resources, I believe, and they just work for buyers. They don't work sellers at all. But what I tell my customers in reference to buyer brokerage, by law, we have to explain what's called an agency disclosure form to all of our customers, and it explains what a seller's agent is or a broker's agent. And they explain buyer brokerage and how I can represent them. I then recommend to my customers, let's go out as a traditional relationship 2 or 3 times. Make sure I'm the right person for you. Make sure you're comfortable with me, you're confident in me. And also, on the other hand, I want to make sure that they're not looking for a $500,000 house for $300,000 and I'm spinning my wheels. So I recommend that you go out once or twice traditionally with the agent, make sure that they're the right person, and then talk to them further. If they don't bring up buyer brokerage to you in the initial disclosure conversation, the odds are they don't spend any time doing buyer brokerage. So, as a rule of thumb. All right. Some of the websites, probably the best one, if you're looking for a home here on Long Island, is multiplelisting.com. That's really the best one out there. Realtor.com is the most visited website, but it's also for the whole country. So if you look at other parts of the country, go to Realtor.com. Oh wow, I spelled Century 21 wrong. Century21.com, ColdwellBanker.com are both very good websites. Zillow and Trulia get a lot of use. I personally aren't thrilled with them because they don't update their records regularly. They have a lot of homes that are sold, that are off the market, that still show up there. Multiple Listings website, it clears all that out. If it's not, there is some lag time because a house may have half-signed contracts and may not come back for a few days, but they update them as accurately as possible. Listing Book is a website that you can only get into if a real estate agent signs you up into it. What Listing Book does, the criteria that you put in that you're looking for, any homes that come on the market or any price changes that meet that criteria will send you an email on it. And it also sends the agent who registered you in the account so that if you didn't see it, hopefully I saw it or vice versa, we get you into those homes. Those are the most popular websites. Like I said, Multiple Listings is probably the best one here on Long Island. Now, why should you, yes? I'm sorry? Yes. Right. Okay. Right. So on Craigslist, you have Craigslist also. Craigslist doesn't have that much. We find a lot more rentals on Craigslist than home purchases. So. Yeah. Something also to keep in mind, most homeowners, when they first start looking to sell their home, is looking, they have a pie-in-the-sky number. And the first place they try to sell it is privately. So a lot of those for sale by owners are people that have unrealistic expectations. Or a real estate agent went in there and told them it's only worth X number of dollars, and they're going to show the real estate agent how they can get a lot more. The other thing I tell you is this. If you're going to forSaleByOwner.com, you're probably trying to save a real estate commission. And the person who's selling the house is trying to save the same commission. These both can't save the same money. So, what was that? So just something to point out. Why buy instead of rent? Here's the information I put in. $300,000 purchase price, $289,500, that's 3.5% down payment, 30-year mortgage at 4% interest, and I'm saying the homes will appreciate by 3% a year for the next 5 years. Purchase is tax bracket 30%, $10,000 annual property taxes, 3% appreciation rate, monthly rent payments of $2,000, and starting year one. Over 5 years, your increase in equity, that's between what the house appreciated in value and what you paid off in the mortgage, is $75,000 plus. You saved on your income tax over $32,000 because of the tax advantages of homeownership. And you saved $127,000 plus in rent. So by owning that house for that 5 years, you saved $235,000 versus if you were paying rent. To break it down a little bit further, the property value after 1 year would be $309,000. After 5 years, it would be $347,778. Loan balance would be down to $284,000. It would be down to $261,800 after 5 years. Your taxes saved. The first year, you're going to save over $6,400 on your income tax. Now, what I'm talking about there is if you made $100,000 in year one, and year two you buy a house on January 1st, and everything else is identical, you're going to get back an extra $6,446 because you own that property. The next year, it comes out to be $6,443, $6,440, $6,435, and $6,428. The reason why it's a little bit lower is as you're paying off the mortgage amount, you don't have as much interest that you're writing off. Your monthly payment with principal, interest, and taxes is $22.15 a month. Now, if you're paying $1,500 a month rent, $1,600 a month rent for a house, if your tax savings, when you take that tax savings into it, you're really only paying $1,628. So if you could afford $1,500, $1,600 a month in rent, you could afford $2,200 in mortgage payment with no trouble. At the end of 5 years, it'll be $2,284 your mortgage payment would be, and it'd be $1,748 the actual cost. So that's the reason why you buy real estate. It gives you the security of home ownership. It gives you the tax shelter. If something goes wrong financially, it takes some time to get rid of you. On it. And the appreciation. You can't find a better return on your investment. By the way, that let me just go back for a second there. That $75,000 increase in equity, that's based on a $10,000 investment. Think about that. They only put $10,500 down. And that's a big increase, big return on your investment. 3.5%? Believe it or not, it's easy to get. The question was, how realistic is 3.5% financing? It's easier to get. I feel very confident that's realistic over the next 5 years. I'm just seeing what's going on right now in the marketplace. I'm seeing, it's not showing yet, but I'm seeing the trends right now that's taking place. I have communities where, I have one area where it's not being noticed because all the high-end homes on the South Shore aren't selling because of the storm. So the average selling price in that area has only gone up 1 point. But when you look at last year, when you looked at the numbers, they had a lot of homes that sold for over $600,000. This year, nothing sold over $600,000, and the property values went up. So there's a lot of trends that are showing that 3% should be very conservative. Well, if the interest rates go up, it could affect it, but at the same time, there's talk that at least for the rest of the year and into next year, rates are going to stay the same. Until unemployment goes down to under 6.5%, they plan on keeping interest rates low. So that's what I've been hearing in the news, so forth. So, right? When buying, short sales, short sales are one type of product. Foreclosures, REOs are real estate owned. That's the foreclosure after the bank takes it back. Estate sales, and a homeowner who's upgrading or downsizing. Those are different options of the type of homes you can buy. The short sale is when the seller owes more money to the bank than what the house is selling for. I just sold a home in Ronkonkoma for $160,000, and they owe $245,000 to the bank. We're waiting for the bank to tell us yes or no if they'll take the lower price on the home. When we first put the sale together in November, the seller said to me, Joe, is there any chance I could squeak out until June for my kids to graduate school? And I said, there's a slight chance, but don't count on it, because all the federal laws say you're supposed to get things done in 30 days now, once the paperwork's handed in. Well, I'm meeting the appraiser there on Wednesday, so much for getting it done in 30 days. He's guaranteed June now, no trouble. The big problem is that with the short sales, it takes forever. If you're a seller who's in a situation where you're selling by short sale, you want to make sure that all debt is satisfied if they accept the terms. You don't want the bank coming after you for a deficiency judgment later on. Like I said, anything from 4 to 8 months for all the paperwork to be submitted for the short sale. If it's an approved short sale, occasionally you hear brokers say, well, this is an approved short sale. That means the bank's already looked at all the paperwork, and they're giving you a number that they're willing to take, and they won't take anything less than that. So, truthfully, those are better situations because you know what you have, and they'll get the approval then in 30 to 60 days. Foreclosures, going to the courthouse for the auctions. You must buy all cash. You have to close within 30 days. You're responsible for the eviction of everyone in the home. You bought as is. You're responsible for all repairs. And the other thing is that you don't know what the inside looks like. So unless you're very skilled and very knowledgeable and very experienced this way, it's not for most people. REOs, if no one buys the house at foreclosure auction, the banks then take the property back and they put it back on the market. These are properties that in some cases the banks fixed up, others they left it as is. Some of them you have to buy it all cash. Some of them require you to go for what's called a FHA 203K mortgage. What that is if you're buying a house to live in, they'll lend you up to $30,000, $32,000 of additional money to do renovations to the home to improve its value. It might be a kitchen, it might be a heating system, it might be a roof. It has to be done by a licensed contractor. You have to submit 3 estimates at the time you go to contract, and the loan app would be, when the appraiser comes over, not only do they appraise for the value of the home, but they appraise that when you do the extra work, the home will be worth the extra money also. You could be inspected, you can see the inside of the house, and it's sold as is most of the time. Estate sales, in my opinion, these are the best values. You're able to finance them. You're able to have an engineer inspection. By the way, the foreclosures and the REOs, most of the time you can't have an engineer inspection because there's no power on. Utilities aren't working. Estate sales, it's one person inheriting a lot of money, and they might say, you know what, just get rid of it, and you get a little better deal. Or it's 10 people, and it's like, if we come down 10,000, it's only 1,000 out of our pocket. So my feeling is that you have sometimes better deals with the estate sales than any of the other options out there. Also, in the marketplace, there's always 2 different types of markets. We have what we call the real market, which is between 20 and 30% of the marketplace. Those are the sellers who are priced right, they're very realistic, and they're trying to get the home sold. And then you have about 70% of the market, and these are overpriced properties. These are people that are in a short sale situation where they're trying to take as long as possible because they're not making mortgage payments. These people, they're really motivated to sell their home. A lot of wasted time and effort with them. So it's important to find out when you're out in the marketplace who's realistic and who's not. Most of the time, a good agent in the area knows what's going on. I mean, I've had customers, I'll tell them, look, let's not waste our time in this house. It's been on the market, and they keep playing games with it. So, I mean, the local agents who do a lot of business will normally. Well, listings expire. So every listing has a start date and an expiration date. So once it hits that expiration date, it has to be relisted. It might be relisted with another agent or with the same agent. Today, a lot of the agents, they let it expire and write it up as a brand new listing instead of just extending it because it puts it back out there. So a lot of people ask me, Joe, I bought my house 5-6 years ago. I paid a lot of money for it. I'm going to lose money on it. And my answer is, if you're looking to upgrade and stay locally, you're ahead of the game. If you had a $400,000 house and it's now worth $360,000, you lost $40,000. But the $600,000 house that lost 10% lost $60,000. That's worth $540,000. You're actually ahead of the game by $20,000. It's difficult for a lot of people to swallow. They're like, well, I don't want to lose money because. But when you look at it, the other part of it is you're buying a house that you're getting now at such a steep discount from what you would have paid 5, 6, 7 years ago, right? Any questions? You could get what's called a bridge loan, where they'll lend you money on the sale of your one home to utilize to buy the other home. So you have some lenders that will give you what's called a bridge loan. If you're going for an equity loan, some people take an equity loan in their house and use that to buy the next home and then pay it off when they sell it. You cannot get the equity loan if your home's on the market. So apply for the equity line first, then put your home on the market. Otherwise, they won't approve you. They don't want you using the equity line as a bridge loan. Right? If you could just, before you leave, if you could just fill out the survey and leave it with me, I'd appreciate it. Anyone else have any other questions? Yes. It should actually stay without STAR, all the taxes. STAR is State of New York, a lottery ticket that we buy. It's supposed to go for education. And what they decided, I guess about 10, 12 years ago, was to give it towards the school tax. So what the STAR say, every listing should be without STAR if it's on the real estate board. That's our requirements. And then in the comments, it should say STAR savings of $1,000, $1,200, $1,400. Every school district has a different amount. And basically, your taxes are loaded by that amount. Correct. Without STAR. On the listing, it should say without STAR, where it says taxes. Or it should just have the taxes without the STAR. Right? Also, they should have no exemptions or deductions on that. If you're a veteran, you get veterans deduction on your taxes. So keep that in mind if you're buying a home. Any other questions? Yes. It could go up or it could go down. I'm not sure the formula in Suffolk County. In Nassau County, we use full market value. So whatever the price you paid for the house, they take 1/4 of that as the assessed valuation. So what I tell my customers is let's look and see what they're taxing it at, what the assessed valuation is, and see what you're paying for the house. If it's above that, then you know your tax is going to go up by this amount. If it's below, you know it's going to be reduced. Well, if you're living in the house and you're moving into another home for more money, it's just rolled over. There's no capital gains. Right. If it's an investment property, then you fall into capital gains. Right? If you've lived in the house 2 out of the last 5 years, they'll consider it owner-occupied. So, okay. Any other questions? Anything else we can answer? I want to thank everyone for coming.